What is up, everybody? How we doing? Happy Wednesday. Hello and welcome to the Commercial Real Estate News Hour, a weekly podcast at 3 p.m. Eastern Standard Time, where we come to you to discuss current events and everything commercial real estate. My name is Henry Eisenstein. I'm here with my co-host, Rafael Callazo. How you doing, my friend?
Great, man. Can't complain. It's another beautiful week. I am going to be heading to Argentina on Monday, so looking
Very
forward to
nice.
that trip. Not so much the flight.
Finally enjoy some good weather, huh?
Yeah, it's going to be in the 90s over there, so I will send you some pictures with some sunglasses and shorts and a t-shirt. So
get a tan.
Get a tan, yeah. So I'll come back in February when it's in the 60s here, and then everyone will be jealous. But no, we're excited. My wife Melanie is excited, and I think it'll be a fun trip. So,
are you just for vacation, going out to see anybody? Or
yeah.
what?
So, what's funny is my brother is actually he's a developer in a cryptocurrency space, and he's kind of like a traveling vagabond or a digital nomad. So he was in Turkey for a while, then Poland, and in Italy for a month, and now he's over in Argentina. And our birthday's next week, so I was like, well, I might as well be together on a birthday. So if we're flying down to see him in Buenos Aires, and then then he's gonna hop over to Japan. So,
well, happy early birthday.
Thanks, bro. Yeah. We're twins. We're fraternal twins. We don't look anything alike, but
oh, that's funny. I was gonna say you should have him jump on the podcast and let's see if anyone recognizes him.
Yeah. I mean, he's very much an engineer, so it's kind of funny sometimes. But he's obviously a brilliant guy and really really good dude. But yeah, I'm excited. I think this will be a really good discussion today. I mean, there's a lot of new news that we can highlight. So
yeah, let's do it.
To doing it.
Yeah, we got some interesting news today.
Oh yeah. Oh, you mean your personal or just in general?
No, I mean I was reading through some of yours, some of my articles, some good stuff today.
Absolutely, yeah. So obviously, Janet Yellen, the former Fed chair, now is obviously heavily involved in the political front, on the finance department. Expressed concern about U.S. commercial real estate, but says that the stresses are actually manageable. Kind of the premise of the article is that obviously COVID-19 affected commercial real estate greatly, and that we had a real big run up in values. There's a shift to more at home work, which has caused a lot of dislocation in the office market. Kind of the same narrative we've been hearing over and over and over again. The biggest, obviously, risk is in the regional banking system versus the national banking system. The J.P. Morgans, the Wells Fargos, the Bank of America is really the largest lenders in the country. Their exposure in commercial real estate is very manageable. There's very little risk of them being in a capital crunch come any type of catastrophic event that we're projecting. Really where the exposure lies is, and especially in the commercial real estate space, is in the regional banks, because those are the banks that usually do the majority of the loans for different commercial real estate in these markets. And so they're kind of describing some of the ways that they're able to hopefully mitigate some of the risks that are involved with what's coming forward as far as potential, defaults on especially in particular in the office sector. But I think one of the morals is that, it's not going to get to a point where 2009 or 2008, 2009 financial crisis, it's not going to be anywhere near that. And if there is dislocation in the commercial real estate market, it's going to probably be regional, and most banks are going to be okay. There may be some banks that get hit harder than others, and there may be some bank closures, but in reality, I think, again, kind of reiterating, it's going to be a little bit overblown as far as what people are saying about the market.
Yeah, I think, Patrick McDavid was talking recently about Jerome Powell, how he just mentioned that he was only going to do 3 rate cuts this year instead of the proposed 4, I believe, or possibly even more that was proposed. But I believe they agree, or they had mentioned just recently when he was just asked up, which I believe was like literally a couple days or last week, maybe at the latest. But he was saying that he's only going to do 3 rate cuts this year, right? So we're not going to drastically see the massive drastic cuts in rates, right? And like for at least from what we're noticing, we're probably looking at only 25% or 25 basis points per rate cut. For the 3 quote cuts this year, right? So it definitely doesn't exactly seem like they're going to be doing a lot of changing in the real estate interest markets. I agree with you 100% that I think a lot of the actual challenges are in the smaller regional banks nationally, where the larger big banks are really not going to have major issues here, but it's the smaller ones that are going to have some trouble. So I'm definitely interested to see how that goes. And but Patrick was actually mentioning where Jerome Powell is actually working more. This is an interesting thing where Jerome Powell seems to be acting in his own interests, right? Best for the country, not his own, like not working in the best interest of the country, but working specifically where he's not leaning towards either direction politically, which seems pretty interesting to me, because they're saying if Trump were to get elected, he believes that it sounds like he's going to remove Powell and try to reelect a different official so that they're going to cut more rates. And if we go Democratic, they're looking at possibly keeping the same, keeping Jerome and trying to influence him to do almost zero rate cuts, right? Like keep the rate cuts to a very minimal basis. So I'm very interested to see how this year goes. I mean, obviously, I'm incredibly optimistic. We talked about being super optimistic this year. I think there's a lot of money sitting on the sidelines. And these types of articles keep coming out because I feel like they just don't know what to say because there's so much of this quote distressed loans out there. But I think it's all in the Fed chair's hands right now, and we'll kind of see how that goes.
Yeah, and I think the reason why we didn't have an immediate dropping of rates is the job reports came back very aggressive. They showcased that we added like 300,000 jobs, which to me is mind-boggling. I don't see where these jobs are coming from because
I don't know either.
Every other day you see reports of banks, not banks, but different employers just cutting people. Like here locally, UPS has announced they're going to be cutting a bunch of people. Humana, all the tech companies have cut tens of thousands of employees. So I'm just kind of shocked as to where these jobs are coming in, and obviously the fact that they're his decision making is so driven on that particular report, when in reality, I think I wouldn't say it's fabricated per se, but I think there's definitely some fudging happening because there's no way
we can call it BS. Let's just call it BS.
Can call it
is BS. A load of BS.
I think it is a load of BS, and I'll go ahead and say that. But unpopular opinion.
No, it's all right. Listen, we like unpopular opinions here. I think Jerome Powell. I think your thoughts of focusing on the jobs reports is a load of BS. I'm in agreement with you. I think that he's not paying attention to a lot of different things. I think that not saying that we need 6 rate cuts this year, but I think that just which I think he's actually done an unbelievably good job in not destroying the economy. I think he's managed to do a very good job with that. I do believe that I wish we had a few more rate cuts. I wouldn't say a lot because I think that things are going to skyrocket again value-wise on the residential side, which is just kind of unmanageable. But somewhere between 3 and 5 rate cuts this year would be nice, but we'll see what happens. Anyways, this is an interesting article that I thought was actually kind of unique. So Chicago has the very first vertical warehouse, I guess this is ever in the U.S., which is super interesting, which is a massive distribution warehouse, okay? And it's 2 stories, and each story is 30-plus foot ceilings. So I'm very, very curious to see how this goes.
Sorry. Let me roll it down here. Sorry.
No, you're good. So I think it was like 30-foot ceilings or so. Very, very interesting. Curious to see how this goes. But apparently they have these in Europe, and this is going to be the first one here in the U.S. They have a lot of sites apparently set up. I'm curious to see the explosion of these multi-tiered, multi-story warehouses. It's going to be very, very, very interesting, where they're going to basically layer 2 huge distribution warehouses on top of each other, which I think makes a lot of sense. Especially for these major populated areas where there's a ton of distribution necessary. Where this says, if you scroll up just a smidge.
Yeah, I'll scroll up right now.
Sorry, I just want to see what this says here. San Francisco-based developer Prologis built the first vertical warehouse in the United States, completing a Seattle project for Amazon in 2018. Since then, such projects have been on the rise, including 10 multi-story buildings.
Sorry. Yeah.
10 multi-story building, including 10 multi-story buildings recently finished or under construction in New York City alone. Which is super fascinating here. And this vertical warehouse is coming in many shapes and sizes. This is as high as 22 stories in Hong Kong. I mean, this is freaking this is unreal. I mean, very, very interesting because in Jersey, there's actually a lot of these multi-story warehouses, but, very old product, which probably should be knocked down and rebuilt. And I've always been so curious as to why they only do, one story when they could easily fit these huge multi-story locations, just for better use purposes, right? I mean, like
Yeah,
more
and
efficiency.
the cost of land, especially in these densely populated markets, is absurd. I mean, I would imagine there's probably a use case even in Miami, like South Beach, if there probably is a use case at some point to start integrating vertical warehousing. At Chad Griffith, who's a buddy of mine, who's also a
Yep.
content creator in commercial real estate, we had talked about this on a podcast of ours in the past, that this was becoming more viable in some markets, which is nuts. I mean, if you think about it, like the engineering and infrastructure that has to take place to make sure that you can store, because obviously what you're storing in here is could be heavy machinery, could be products, talk about millions of pounds of force that's on these buildings. And as you start stacking these plates, I mean, you're talking a lot of physics and engineering that goes involved into these projects. So kind of interesting.
Yeah, I mean, huge build. I mean, like, I love this picture. This is pretty interesting to even see. I'm very curious to see how this goes. I mean, definitely think that a lot of these large metros are probably going to end up seeing a lot more of these.
Yeah, because I mean, land. I mean, you're running out of land. Where are you going to build? I mean,
yeah, you just got to go up.
Yeah, you have to. Yeah. Otherwise, it just doesn't really make much sense to continue. We got some comments coming in, so that's great. Keep them coming.
Let's see here. Go for it.
Yeah. All right. Go ahead and share my screen real quick. But in the meantime, we'll go ahead and throw up some of these comments just so we can engage with you guys. So you got someone saying they aren't new jobs. So that was in reference to what we described in January. They had their jobs report. They aren't new jobs, they're recovery and or upgrade or downgrade jobs. But yeah, I mean, I'm sure a part of them are, but when you factor in, the job reports we've been receiving over the last 3 years, are we at that point now where is it really recovery, or is it, what exactly do those entail? And I'd like to, and again, that's maybe my ignorance as far as not digging into the jobs report from a really granular perspective, but that's just kind of something I'm questioning. All right, yeah, and they were referencing rate cuts as well, but we'll go ahead and move on to the next article in the meantime, and then we'll keep the comments coming, guys. All right. So next up is office to residential conversions have surged by 375 or 357% since 21 as billions in commercial mortgages come due. So, this is somewhat of a misleading article, as many are nowadays. So what they're describing is that there has been a big influx of developers that are looking to convert some of these office properties into residential uses. So since 2021, the number of office to residential conversions has skyrocketed by 357%. So 3 years ago, the U.S. had roughly 12,100 office to apartment units ready to be converted. Now we're looking at 55,300. So obviously that's a significant jump. But one of the things I did before hopping on this call was to kind of look at new product that's coming to market in the multifamily sector as a whole. So as of 2023, we're delivering 440,000 apartments to the marketplace. And in 2024, that number is set to increase by, I think, like 10% or 15%. So it's a pretty sizable amount. So in reality, 2024, we could be delivering 450,000 apartments to the marketplace. So if even if you factor in the 55,000, which is definitely nothing to sneeze at, that's roughly 10 to 15% of all the inventory would account for this conversion. So it's relatively small when you compare it to the overall size of the new deliveries when it comes to multifamily. So, I'm definitely not trying to make light of the fact that this is important, but it isn't necessarily something that is, a huge piece of the multifamily puzzle. But, obviously this is something that a lot of cities are exploring because of the fact that office properties are just not being utilized to their highest and best standard. I'm sure over the next several years, we'll probably see more and more corporations consolidating their footprint, which leaves a lot of space to be able to be modified. But, I think the hardest part to do this, as we've said before, is that the configuration of a lot of these office properties are not suitable for office to apartment conversion. So,
yeah, I was just going to speak on that, which is really, there's a lot of talk of this, right? Like where, you have these huge office buildings. What do you do with them? Can you convert them into apartments? Because there's the housing shortage. It's like, it's nice to say that you could do that. However, it is incredibly expensive in a lot of cases to actually execute on that. And there's a lot of buildings where it would actually be almost just as expensive to knock it down and rebuild as it would be to just convert it. So it's just keeping that in mind where, you're going to be, I mean, like you're talking 80% of the same cost, right? Where, for conversions. And it's like, sometimes is that even worth it for it to be a really wonky building versus to try to really maximize the amount of units that could be built? It's just, sometimes, office buildings they're not perfectly built for it. I mean, the odds of, because the plumbing lines are always going to be off because it's not built for suiting for that purpose. And that causes a lot of issues. And, having to run all these new lines and reconfigure all these things makes it incredibly difficult for a lot of these office buildings to be maximally utilized as apartment buildings. So I think it's a nice, a nice thing that everyone has in mind. And I think the idea is good and like the intention is good behind it. I just think that it's not as lucrative as people are thinking. Like if you're actually a broker or investor looking to try to capitalize on this opportunity, in some cases, it's actually fairly lucrative. In some cases where you can get a property for an incredibly cheap price. However, what's probably more lucrative, at least what I've seen, which is more financially lucrative in some cases where apartments aren't, is converting it into self-storage. Converting these offices that are basically vacant, huge office buildings that are vacant, converting it into self-storage because you don't need the plumbing. You don't need the same type of, a lot of different pieces and components for the apartment conversions. Self-storage just might be a lot more simplistic to do. So just keep in mind that, like, don't always just think with the run track mind. There's going to be many different opportunities that you can look into.
Yeah, 100%. And really, I think a lot of, to really make headway with what they're trying to propose or describe, like it's going to take a lot of public-private partnerships. So, a lot of these cities are going to have to really say, look, like we want to make a concerted effort to start, bringing in developers that will want to take these projects on because they're going to take a long time. It's going to be extremely expensive. And oftentimes it's not going to pencil unless they have some public funds behind them to be able to do it. So I figure that's probably what's going to end up happening, but only time will tell. So.
Yeah. So anyways, this was an interesting article that I put on here because in the very beginning, like if you scroll down just a smidge, it basically just talks about what apartment pros, these are big time big time apartment guys, these big companies, what they're doing. And it basically just says a lot of them are sitting on the sidelines, right? It's just like, what are they doing in these types of years? To adjust with the interest rates. It literally just says they're sitting on the sidelines. I think it's absolutely hilarious. It's like, oh, deals have slowed. What are they doing? They're actually just not buying deals. Was one of the things. And then the other thing was they're just adjusting their locations because they're saying how, the insurance markets right now are incredibly inflated, where the pricing has skyrocketed from, in certain locations from a few $100s to a few $1,000s per unit for insurance, specifically talking about the Californias, the Floridas, and a few other states nationally that are really seeing these major difficulties when it comes to insurance costs. And obviously, listen, with the interest rates being where they're at, it's definitely making deals a little bit more complex. However, what I think is so freaking fascinating above all this is that it's like we went from where, guys, 4 to 6% interest rates, or let's just even say 5 to 7, okay? 5 to 7% interest rates is literally what has been on average for the last 40 years, right? It's the 5 to 7 range, right? I'd even beg to say higher. I would bet to say a smidge higher, right? Maybe even like 6 to 8 has been like the average for the last, if anyone wants to look that up, for the last 40, 50 years, it's between 6 and 8%. So it's like with all these people who then, that being said, went through the period of time right after COVID where interest rates dipped to 2s and 3s. We got so enamored with how this now the new normal should be super cheap rates. Now with rates being back to 5, 6s, it's like everyone's freaking out about doing business. It's like, guys, there's still an unbelievable, like this is what it's always been. So you should get used to being able to do deals with interest rates where they are today, because if you don't get used to it, like especially for a lot of the newer brokers out there who've only been in the business since the COVID or really started taking off throughout the the late teens to 2020s and change, right? It's going to be very difficult for you if you think we're going back to that, because I think this is the rates are here to stay. And I think we're going to be between 5 and 6 and 5 to 7 for the next 10, 20, 30 years. Right. This is just going to be the rolling average and get used to it. So anyways, I thought this would be pretty interesting to look at.
Yeah, I mean, you just hear one Denver deal involving DB Capital Management saw an insurance premiums rise by 250%. So,
It's ridiculous.
It's crazy.
Stop buying properties in these areas.
I mean, I don't know. Like, I hate to say it, but when I saw it happening throughout COVID, and I saw these different syndicators popping up and saying, "Oh, this is what our strategy is, and this is what we're targeting," blah blah blah. I mean, it did give me kind of cause for pause. And granted, I mean, it's not a uniform thing that everyone has kind of gotten out over their skis when it comes to multifamily investing, but there was an exuberance in the market for a period of time in the space. And, industrial too. I mean, I'm not saying industrial wasn't also in that realm, but industrial seems to still be performing pretty well, whereas multifamily has definitely taken a step back over the last, I want to call it, a year. So I think it's still
there's also like some
property types.
Yeah, but I agreed. But I'm saying, like, it's like, guys, there's only a few states that are getting absolutely decimated when it comes to insurance premiums going up. Like, not every single, let's just be blunt, like, not every single state is seeing a 250% or 300 or 400% increase in insurance rates, right? Like, let's just be honest, right? But if you're buying in Denver or California where there's fires, right, or Florida with hurricane issues, what are you expecting?
Mm-hmm.
Right. Like, you are going to have troubles when it comes to insurance. Case in point, period, end of story. So it's just look in markets where, like, there really hasn't been any craziness in the last 10 or 20 years, and you're probably going to be okay.
Yeah.
Like insurance, I don't know what it's been by you, but in Jersey, it's not like it's gone up drastically. It's gone up maybe 10 or 20%, but we're not talking 300 or 400%.
Yeah, no, we've gone up a little bit more so because we're kind of in tornado alley. So we've had some, catastrophic tornadoes, not necessarily in Louisville per se, but regionally, we've had some pretty bad ones that I'm sure is going to affect the insurance costs, but not nearly as bad as like a Florida, Texas, some of these other markets that have just been affected greatly by, primarily weather. So, all right. So next up is Latin and Tex-Mex overtake Italian as America's go-to food order. Now, the reason I wanted to share this is because I think it's important to look at consumer trends when it comes to commercial real estate, or really any industry. But real estate formulates around businesses. So as consumer trends change and businesses change, that obviously is going to affect or impact the commercial real estate needs of these businesses. And so they talk a little bit about in this particular article about how the rise of the Latin population in the United States has greatly impacted the flavor profile that people are seeking in their menus. And so you're seeing a lot of these restaurants around the country starting to incorporate more cheesy concepts, spicy foods, really just foods that have Latin-inspired ingredients, etc., because of the changing palate of these newer generations. Now, in here, they referenced that the millennials were the first generation that actually preferred Mexican cuisine over Italian cuisine. And now Gen Z prefers Mexican cuisine and Chinese cuisine over Italian. And Italian obviously has been kind of the mainstay in the United States for decades and really for many, many, many years. And not to say it's still not a very popular trend, but nowadays newer concepts and the industry, the restaurants that are focusing on the Mexican concept in particular are doing extremely well. We'll see a little bit later the graphic for Charter, which is a phenomenal service that I always encourage people to look at. It showcases like Chipotle and some of these other Taco Bell. They're some of the fastest growing fast casual concepts out there right now. And obviously it's because of this changing palette of the demographics. So I just thought it was kind of a cool thing to share. And then
I'm like, what are you like looking into like Miami? Cause like I'm surrounded by like all this, Spanish, Latin food and Cuban.
Oh yeah.
There's so much of it around here.
Yeah. I mean, it's little Cuba. I mean, you don't in Miami, and I've never been personally, but I'd love to go one day. But from what I understand, you don't necessarily even have to speak English when you're in Miami. I mean, you could get around pretty easily without having to speak any English. And luckily I'm fluent in Spanish, so I could probably navigate pretty well.
Yeah. Thank God my fiance helps me out with that. I'm the guy who just points at the menu or orders on Grubhub.
Yeah, there you go. But yeah, you'll kind of see here some of the things I'm just thought I'd kind of point out. It's keywords that they're tracking. So keto obviously has become pretty prevalent as far as one of the fastest growing terms on menus. Calorie has dropped off significantly, as well as free refills. The espresso martinis, I'm sure you're probably seeing this in your market. They're super popular here. It seems to be like the new hip thing is to have espresso martinis, whereas like
let me be clear. I think I was an espresso martini guy before it got hip. I'm just saying, I'm not a big drinker, but I know I can go for an espresso martini every now and again.
Yeah. So, anyways, I thought I'd share this because I thought it's kind of a different from what we typically talk about, but again, it has a vein in commercial real estate in that it affects consumer trends. So,
yeah, I mean, look, this is have you looked at? Is there any software that you feel like you've used in the past that has been incredibly supportive for seeing like what type of tenant would be really lucrative for a certain opportunity? Is there a type of software that you found that like kind of gives you a gauge of like what tenants are local and what is like this area missing?
Well, so I use Placer AI a lot, more so related to geofencing.
That's what it was.
Yeah. And that does. So they have a concept called geofencing where they drop like pins around a particular site and then they track cell phone data and cell phones to see what the foot traffic is for a site. So that kind of gives you an idea of what type of volume that sites are having. So, that's more of a general thing. But outside of that, you can kind of see in the trade areas, okay, well, there's a couple Mexican spots, or maybe there's, some fast casual pizza place or something, but maybe they're missing like a fusion Asian place, So a lot of it is just sitting there and trying to figure out, okay, well, what could potentially work well here and what uses need certain things. So certain uses would prefer a drive-through versus an inline space. Like there's a local concept here called Duck Donuts that is like a coffee shop,
and then we had one of those in Jersey.
Oh, you do? Okay. Yeah. So they have the small donuts that you made to order. So those don't do drive-throughs, which is kind of shocking to me because it's obviously a donut / coffee shop, but their concept doesn't incorporate drive-throughs. So that could be a great spot for an inline space versus some other concept like that really needs a drive-through. So I don't know. I don't know if it really answers the question.
Maybe it could be a what is it called? A Mick what? What's the new thing?
Cosmics.
The Cosmics. Yeah. Maybe McDonald's is going to come back.
Yeah, that's a killer concept. Apparently, in that article we read it. I mean, they're killing it. They're crushing it. They're going to open up apparently 9 sites in Texas this coming year. So,
insane.
All right.
All right, what do we got here? So, all right, 3 signs flight to quality might not be the best to describe the office market. So, this was an article that came out that I was reading a little bit into, which was kind of fascinating to really see here, which here, number one, the share of leasing volume at higher quality buildings gets smaller. So if you stop right here, this is basically just talking about how in 2019 versus the 2022 marker, you can see at the very bottom, 1 and 2 star, 3 star, 4 star, 5 star. In 2019, again, prior to COVID, it was very heavy in the 3 to 4 star market. A lot of, a lot of people really looking at that, but the bigger differences was the 2 ending pieces. If you look at the 1 and 2 star and the 5 star ratings, right, you were seeing that there was, over the last couple of years, people have transitioned more so away from the 5 star locations. It's actually, it's got that that slice of the pie has gotten smaller. And then you can see that if you go back down if you go to the 1 and 2 star, you see that slice of the pie has gotten larger. So people are actually trending downwards instead of upwards when it comes to the quality of the building. In my opinion, I think they're seeing this because number one, they don't really need as much office space as they once thought. In other aspects, I feel like they're also saying like, hey, like I could get, twice as much, 3 times as much, 5 times as much space for the same price in these types of other locations. And especially if people are going to be hybrid models, why do you need a 5-star location? It's just a very, very interesting thing here. And then second, this is also really interesting. So this is lease sizes. You can see here the change in average new lease size. So this is showing you that the percent and difference in change. So this is saying that there's a major difference. If you look at the 5-star, there's a major negative 45% nearly in the 5-star spaces that people are decreasing their size by almost 50%. For the 4-star spaces, they're decreasing by almost 30%. For 3-star spaces, they're decreasing by almost by just shy of 15%. And the 1 and 2-star only, decreasing by 7.5%. If you scroll down, which is also super interesting that obviously, we're noticing that everyone's condensing their spaces. And lastly, the older buildings. So this is to go to show, I mean, look at the net absorption.
Wow.
Percent of inventory available. I mean, wild to me. Wild. I mean, you're seeing, I don't even know what the increase of this is. I mean, we're talking hundreds of percent in difference, decades of construction. So this is just percent of inventory. So you can obviously, we go from, uh, virtually none to the largest amount of inventory in, for net absorption in, I don't, what is this, the last 40 years?
Yeah.
Office space went from like one of the strongest sectors to honestly one of the weakest. And this is really goes to show how, things have drastically changed and you just need to be able to adapt and shift. I mean, I was just talking with somebody recently who, they have an enormous office portfolio and they're being really hit hard, but if you can transition them into medical office and, there's a lot of medical office space that's doing very, very well. So it's being able to shift and adapt with the new trends and not being stuck with it. So very, very interesting article. Figured I'd just, bring it back up. This is pretty good data.
Yeah, it says 12-month absorption. So for between February 23 and today's or last month, looks like most of the inventory that was absorbed was product that was built in the 2020s. So, I mean, it's just, again, if you have, if you're one of the, not necessarily one of the only, but if you have a limited amount of lessers in the or people who are looking to lease space in the market, you can kind of pick the nicest stuff because it's like, okay, well, I could get the nicer product for, a price that I couldn't have gotten it, 10 or 15 years ago. So why not go with the nicest, newest, best amenity product? And it looks like all these products, like 1 and 2 star buildings, new construction. I'm kind of curious as to what developers are deciding to do that. It seems like,
well, I'm saying, but this is saying that all the 2020s product is having the hardest problems here. This is saying that the absorption rate.
This is net absorption. This is like what absorption has taken place. So with these older products, it looks like they're losing tenants.
Yeah.
That's what I think it's saying. So the newer product is the one that is getting all the attention.
Scroll down.
Yeah.
Let's go to this. Regardless of the star rating, office buildings completed since 2020 saw a positive absorption of 16-18% of inventory over the last 12 months. And in January, among all the buildings completed before 2020, absorption rate was negative over the same time frame. Absorption was more negative in higher rated buildings than the lower rated ones. The new buildings are managing to maintain lease up demand, while older buildings of all levels of quality are struggling to backfill vacated space. Yeah. Love it.
So yeah, I mean, it just looks like, I mean, it makes sense. Like if I'm in the marketplace for a space, like I'm going to go to the nicest, newest space if I can afford it.
Of course.
And especially nowadays where it's just much more competitive, or not a lot less competitive, I should say, to be able to secure that. So yeah,
I agree 100%. That's what I did recently here in Miami.
Oh, you did? Nice.
Yeah.
Got a space. Heck yeah, bro.
Yeah. Go to the nicest building, negotiate the best lease.
Heck yeah. Well, that's the way to do it, man. That's what you're known for. So good stuff, man. But all right. So next up is a resource that I use all the time. So if you guys are looking for ways to come up with just kind of content that you necessarily don't have to, come up with yourself, this is a great resource. It's called Charter. Essentially, they take a bunch of data and then create visual representations of that data. And over time, I think every other day or every couple days they release kind of a newsletter, as they describe it. So, this is for today. This one is referencing, Starbucks and their losses over the period of time. Kind of highlights just kind of a quick snapshot of what they're talking about that you can reference here. This is one I was actually referencing regarding the changing palette of the new generation. So Chipotle versus Taco Bell. There's room for both to grow as fast Mexican booms. So the article that I pulled was actually, I believe, yeah, here it is, the fastest growing menu items. So they'll link to different articles too. So you may say, okay, well, this is cool. It's referencing a 14% jump year over year for Chipotle and 9% jump for Taco Bell. It may reference in here what the articles are too, so you can kind of dig in further and kind of pull in different things. And I use this all the time where it's like I see an interesting graphic and I'm like, okay, let me see if I can post this on different social platforms, kind of highlight what this is saying and reference what it's saying, and then try to get feedback from the audience. So again, just kind of a unique way to be able to just give visual representation to data that can be kind of engaging. So thought it'd be nice for me to share with the audience.
Yeah, no, I love it. I think super interesting here. What was your biggest takeaway you feel like from all this? And how do you feel like it's shaping your the way you're looking at the business?
Well, I operate heavily in the retail space, and I do a lot in the quick service restaurant space. So again, the new trends. So, cosmic is a new concept, right? The cosmics that we referenced last week, like who knows if in the next 5 to 10 years that becomes a big booming vertical for McDonald's, and maybe there's an opportunity there to build relationships with the real estate department to try to find sites for them. Or, now you're talking Taco Bell, Chipotle, they have massive real estate departments. So if you can tell that they're going to be expanding by 14%, how many Chipotles are out there? Let's say there's 2,000 Chipotles out there. The year-over-year growth last year was 14%. What's the total number of Chipotles that have been brought to market over the course of that year? Several hundred. So would you rather focus your attention on brands and verticals that are growing, or would you rather focus on, the Applebee's or the Chili's or some of these other concepts that are starting to go away? Or not necessarily go away, but they've been struggling in recent years. So it's just capturing these different trends in the obviously this is quick service. The same thing can apply for industrial, right? Because you've got logistics have become a huge deal over the last 20 or 30 years. Beforehand, it was heavy in manufacturing. So manufacturing facilities obviously are still in high demand, but not nearly as much as a logistical center is. That's why you see the new high ceilings, historical or legacy property nowadays, or the legacy property may have 12-foot ceilings, 14-foot ceilings. That's become functionally obsolete because it's no longer kind of the thing you want to have in a space. And so again, it's just it's capturing trends, looking at trends and understanding where the opportunity is going forward because of consumer trends. I mean, this is economics 101, right? It's like if the ship is going in that direction, then we better figure out what real estate needs are required based on what the consumer trends are showing. So
yeah, no, I love that. Great insights.
Yeah. So all right,
I just created my account on Charter, or I just subscribed.
Heck yeah, Charter, CRE Daily, both phenomenal resources. So definitely go ahead and register. Let's go ahead and pull this up. In the meantime, guys, if you guys don't mind, go ahead and type away in the chat box. Where are you guys tuning in from? We're really looking forward to hearing. It's always kind of cool to see how many different people are tuning in from markets all across the country. So if you guys don't mind, go ahead and type away, and we'll read it off here in a minute.
Cool. All right, next. So this was obviously a multi-tiered article. This one talks about how the office attendance hits new high, which I thought was also very interesting based on our most recent topic just 10 seconds ago in regards to the office space. California storm damage could reach $11 billion. And speaking of restaurants are on the rise for forecasting for one of the best years in a long time. So very, very interesting. This is, this piece of it right here talks about the office occupancy rising. There's actually, my cousin works for Dell, and a lot of other companies. And we were just talking about how he just actually got the notice recently that he has to be back at the office. So Dell was posting that. I mean, a lot of these huge organizations are posting back like, hey, if you're not coming back to the office, you're fired. I mean, like it's literally like gotten that kind of ridiculousness for these huge Fortune 500 companies. A lot of them are really cracking down saying like, hey, if you want a job, you got to come in. So we were just talking about that recently. If you scroll down, you're going to see, for those of you out on the West Coast, I hope everyone is okay out in California. California's damage. Actually, we had some of my fiance's family lives out in California. My sister lives out in California. I heard it's been kind of crazy. I mean, the nonstop rain, I think it actually may have just stopped recently in the last 24 hours or so. So I hope everyone's okay out there. A lot of damage, a lot of property damage, almost $11 billion worth of property damage is, this is, I think, more damage from the rainstorm, which California obviously just doesn't have ever, than I believe the entirety of the costs of the most recent hurricane in Florida. I mean, it's just absolutely ridiculous. I mean, to think about how much damage was caused by the winds and the flooding and the mudslides, which is wild to think about. And then obviously, if you scroll down just a little bit more, it also talks about just sort of as you were mentioning, Raphael, which is restaurants are just about to see what a fantastic record in sales in 2024, which is super interesting. So if you're in the restaurant business, if you're doing a lot of restaurant sales, this could be a really interesting opportunity for some people. Like we're going to be, I think they're breaking the $1 trillion mark. They're on track to break the $1 trillion mark in sales in 2024. Last year was at 997 billion. So interesting, news to come. We'll see how the restaurant space goes, but I think there's a lot of opportunity there for those people who are selling and doing business with a lot of these chains, just like you are, Raphael. I think there's a lot of opportunity for brokers to, get a little bit of opportunity there for working with them. So
yeah, no, I mean, look, you can see some of these the survey numbers. Nearly 80% of surveyed operators predict their sales will increase or hold steady this year in from 2023 levels. Although just 27% expect to be more profitable. So obviously, rising costs, and in particular in the labor side, which we've talked about in earlier in this discussion as well. I mean, that's just the hard part in the service industry, is making sure that you can staff your establishment, and you could control costs in that vertical, because the margins in restaurants can be quite slim. So
yeah, this is great news. I mean, obviously, restaurants are also great tenants to have, because either, I heard the old adage was restaurants. It was like, there's nothing more profitable than a profitable restaurant, and there's nothing more unprofitable than an unprofitable restaurant. And I thought that was a very interesting takeaway, which is like, when they're profitable, they're really profitable. When they're not making money, they are freaking losing money hand over fist.
Yeah. It's just, it is a brutal business. I know you knew this, but I had a small catering company in college, and then I thought I wanted to be a restaurateur after college, and got into the management side of restaurants. I managed a small restaurant in Phoenix, and I realized pretty quickly that it was not all it's cut out to be. And really, to make significant money in the restaurant space, you have to be in luxury restaurant and really provide like a really like premier product, or you have to scale. Like, you have to have a lot of different locations. So, and obviously that's very operationally heavy. So, I'm sure you've met a lot of restaurant owners, and they work 80 hours a week. That's just kind of the norm, if you really want to run a profitable enterprise. So
yeah, that's for sure. Well, this one looks interesting here.
All right. So mall giant Simon Property plans to drop $800 million on retrofits this year. So obviously they're one of the largest retail owners in the country. They've already orchestrated 13 redevelopments since last year, but they're trying to do 5 to 6 more in 2024 to kind of spruce up and make their existing products look nicer and more attractive. They kind of describe that, they're going to be doing this based on the cash flows that they're producing. So, they're able to do this with their free cash flow versus just going to the marketplace and trying to raise a bunch of money that could potentially be very expensive right now. So they've done these redevelopment projects across the country on different sites that they currently own. One being an example in Atlanta, where they did a successful retrofit and have a Nobu Hotel, which is kind of a higher end hotel, kind of really cool concept. Restaurant, they've got office space, they've got Lifetime Fitness Center. I'm sure there's some apartments and such incorporated in these areas. So again, they're creating these into almost lifestyle centers, where there's a bunch of different uses on site versus what was historically a power center, or even open air center. I mean, I feel like the way of the future now is to kind of have live, work, play, operate in kind of in a similar general area. So that's kind of the model that they're attempting to follow. And it references some of the retail statistics that we've talked about. So they're obviously doing extremely well. Occupancy at malls is at 95.8% nationally, which is historic highs. And then in some parts of the world, it's even higher. The occupancy rate, which is really phenomenal. So again, just kind of more news.
I would have never guessed that.
Yeah, it's unbelievable. Yeah, U.S. retail vacancy reached its lowest since 2005 in October at 4.8, and the trend has continued to close out the year. So, again, the occupancy rates are just absurd.
Yeah, I'm actually buying a 17,500 square foot retail center in Jersey. Just got that negotiated and accepted this week, actually, personally to buy. So I'm excited about that. But this is great news to see. But I also, there's every submarket's different, so that's why it's just interesting to see this nationally. And then, I'm looking. I mean, this is an interesting value add deal that I'm getting into, and this is in a suburb of South Jersey, so definitely very, very interesting to me. I think there's a major opportunity for retail. It's actually interesting because I also had one of my agents came across this huge mall in New Jersey. We were trying to negotiate that, but there was a major vacancy. I mean, like maybe 30 or 40% occupancy in this building. So it's like when I read articles like this, I'm like, I think that it's so subjective based on locations, So
yeah, and like you said, I mean, you could be in a phenomenal market, but if the building itself is, there's issues with it, or it's not quite in the right area of town, and there's different retail sectors within a city that could be beneficial versus others. So, yeah, I agree with you. I think it's important to note that. All right, so last article of the day. All right. Ooh.
So here we go. This one's juicy. So I wanted, I guess, saving the one for last here. So WeWork, we've talked about WeWork a bunch of times. They went through bankruptcy. They were having trouble getting rid of their leases. And then, funny enough, guess who comes out of the woodwork trying to buy their business back out of bankruptcy? The ex-CEO, Adam Nguyen, is trying to now see if he can buy back WeWork out of bankruptcy, which is just honestly hilarious in my opinion, because it's like this guy literally he's got an unbelievable vision, but next to zero business sense, clearly, because he was basically lying and fudging numbers since day one. So I'm curious to see how on planet Earth this ends up panning out. I mean, for WeWork circumstances, I think he would be the worst person possible to try to get this back on track. Because I think he has absolutely no idea what he's doing when it comes to running a company profitably. I mean, he's got a fantastic vision, and kudos to him. But I can't possibly imagine what he has in store for this that would actually be financially lucrative. So we'll see. I mean, I'm curious to get your thoughts on this one. This is interesting.
Yeah, I'm interested to dig in further into this article, but I remember back in the day before he sold his stake and everything, or he was forced to sell his stake. There was a situation where he was buying buildings and then had,
WeWork in his name.
They leased the building. So I'm kind of also curious as to whether or not him doing this is a way for him to try to sustain some of his buildings, because he's probably got a lot tied up in these different properties too. So I don't know. I mean, that whole thing is an interesting, case study. The guy was brilliant. I mean, he marketed the company as a tech company essentially, when it was really just a real estate company. So when you did the valuation, it was like, oh, we're gonna value this company as if it were like a, NVIDIA or some other tech company. When in reality, it's just it was literally a real estate holding company. I mean, you're essentially subleasing out space to individuals at a higher rate than you would lease the space. So, it was kind of an arbitrage.
Super stupid. I mean, it's mind blowing to me that, what happened in that, but now it's even funnier to see that he's coming out of, the
woodwork.
Out of the woodwork here to buy this property. I mean, his business back. I mean, God bless, good luck. I mean, honestly, I don't know what WeWork is going to do. To be honest with you, I think that, they're kind of, hoping and praying that things are going to work out, because there's a major WeWork here actually in Brickell near me, in Miami, which is absolutely packed, and they make a fortune on that space. But there's a lot of other locations of WeWork right around here that are completely vacant. There's nobody here, right? I mean, I chose Regis because the pricing was just infinitely less. For nothing that I needed, right? Just to, for a huge space, it was a fraction of the cost. So anyways, just, good luck, Adam. I'm very curious to see what happens for WeWork's hopes. I hope you don't get it. We'll see what happens.
Definitely. Well, I mean, that's pretty much it so far. I mean, obviously we appreciate you guys for tuning in and continuing to stop by. I mean, this is like we said, we're trying to make this into kind of the news watering hole for all the commercial real estate industry. So for those of you guys who are tuning in and watching, obviously this is just an opportunity for you to stop by and, hear about just local news or regional, local, and national news and commercial real estate and all the trends. And hopefully this just becomes your go-to every 3 p.m. on a Wednesday afternoon.
Yeah, that's right. Well, look, we appreciate you guys. Thank you for tuning in, and hope you guys enjoy the show. We'll see you guys hopefully next week. I mean, depending on your travel plans, my friend. We'll definitely try to make this work wherever we're at. So appreciate you guys. Have a fantastic week. We'll talk to you later.
See you guys.